let's jump in. So, like I mentioned a second ago, we're gonna look at a true seller carrying the mortgage. And then if a lien stays in place, what are the other two options, wraps and subject tos? So let's discuss first, what is owner financing? It's also, we call it seller financing on the contract. And it occurs when the seller of the property is gonna be the bank. They're gonna be the financing mechanism instead of a traditional mortgage. Owners can finance a primary loan if they do not owe anything on the home, or they could even carry a second lien. So as an example of the second lien option, when I purchased this office in Buda, the bank at the time, the commercial bank, loved small local businesses and they really wanted us to get the loan. So he said, hey, if the owner will carry a second at 10%, then I wouldn't have to, I'd only have to come up with 10% because they'll do the 80%. Banks normally don't like that kind of option, but some untraditional banks will allow that to happen. Or let's say, well, I'm not even going to give another example. There are other examples I can come up with, but I don't want to put them in your heads as options. Okay, so contract with seller financing addendum is used. There is an addendum. I'm going to show you what that addendum looks like here in a few minutes and how to fill it out. But you're always going to use a seller financing addendum if you're doing it true owner financed. Closing is normal. So I get a lot of agents that ask, how does it happen? It's a normal transaction other than instead of it being Bank of America or Chase, or Align Home Loans doing the mortgage, it's the seller themselves doing the mortgage. So everything else transfers ownership to the new owner. The great thing is the new owner is responsible for insurance, taxes, maintenance, all of it. That takes the burden off the owner. That's financing it. I personally prefer as an investment method to owner finance properties versus owning rental property. I think you can make a lot more money. We can talk about that in a little bit, but I just personally prefer this method. When you're the landlord, you've got, property taxes you've got to deal with, and you lose your homestead exemption. Then you've got landlord insurance, then you've got, the maintenance when things break. So in this method, it all comes off the owner and it's on the burden of the buyer. So I personally love that. So the seller's going to be the bank after closing and collects money, issues an end of year mortgage interest statement. So just like the bank, if you guys have a mortgage right now, you probably just got, something like this. That's a mortgage interest statement that shows it's a 1098 miscellaneous 1098. I think it's a 1098 form that shows how much interest was paid to the bank for the year. And as the person who made those mortgage payments, I want that statement because I want to be able to write off some, if not all of the interest on my tax return. So as the owner who's financing the property, the seller will issue a 1098 interest statement at the end of every year. It has to be done in January to reflect the prior year. So and then the other thing they're going to do is ensure that insurance and property taxes are always current. So the way I'm facilitating my owner finance transaction that closes next week, it states, it's going to state in there that they have to provide proof that they paid their taxes at the end of the year and paid them on time. If not, then not me, but my seller as the bank will have the right to foreclose, because the owner who has the primary lien in place will want to foreclose before the county forecloses due to unpaid property taxes, if that makes sense. But let's not worry about that. I don't want to get too far ahead of myself. Okay. Any questions on this page? I really want to go slowly because I want to make sure everybody understands this. And you guys can unmute and talk or chat. Gabe, go for it.
I was just curious, when they pay their taxes, they get just something from the county saying, hey, we paid blah, 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 something that
Yeah, so
simple.
when you pay property taxes, you get emailed a receipt. And the owner, I hate to say the owner because it won't be the owner at that point, but the person who's financing this, they can always go on the county's website and look and see if taxes have shown paid. The problem is there's a delay in the time that I pay them versus when it's reflected online. And so if I'm the person, I'm the bank financing it, then I want to check, about 30 days after the bill came out to see if it's been paid. I was gonna say at the end of the year, but in Hayes County, we didn't even get our bill until the end of the year. So, about 30 days out, and then about a week or two before the late fee is applied, I want to make sure, and the late fees are applied in February. So I would want to make sure it's paid for sure by February 1st. Otherwise, I'm having a conversation with that client, that owner, the new owner, and saying, hey, what's the deal? Get them paid, show me that receipt before the 1st. Otherwise, you're gonna force me to pursue foreclosure, and I don't want to do that to you. So that's,
So in this case, the PITI is different because you're not collecting some of that stuff. You're just getting.
so we'll talk about options in a minute.
Right.
Right now, what I'm talking about, yeah, so there's two ways to do it, but we'll talk about that in a second. Good question. All right. Any other questions on this slide? All right. So items to consider. When it's a really unique property, so I personally owner financed a home, a property. I had a seller, this was several years ago. My sellers had to sell a property. It was a piece of land on Windy Hill Road, great frontage, big piece of land with like 3 different structures and a shop in the back. And the structures were like a double wide and a single wide, and then a tiny little house storage thing and the shop. So it wasn't gonna meet conventional financing terms. It wasn't gonna go FHA, it wasn't gonna go VA. Nobody could get a traditional conventional loan. I could have tried to find a little local bank who could have maybe possibly done a loan on it. But they're gonna want 20% down for sure at a minimum. And so I suggested to my clients who were at the time elderly, they wanted money out, but they didn't need a ton of money. I said, would you be interested in doing an owner finance on this? And they said, yes, absolutely. I explained it to them. They said, that's a great idea. They got a big down payment from the buyer, and then they got monthly payments. Well, about 6-8 months in, somebody came and offered them to buy the note from them. And I said, hey, don't sell it to them. I'll buy your note. So I ended up carrying the note at a discount and made really good money on it. And I became the bank and helped facilitate that transaction until they sold it. So again, I love these as options. They're a great way to make money. But for my seller, what it did when they offered owner financing is allowed the property to be sold to somebody who wasn't going to be able to just go get a loan. And sometimes it's the property that causes that issue, or maybe it's the buyer. Some buyers, are self-employed and not making a ton of money on their tax returns. They may make a lot of money, but tax returns, they don't show enough money to qualify, or maybe they just change careers. Who knows? There's a million reasons why perhaps a buyer wouldn't qualify for a traditional loan. And then there's circumstances like we just had my closing next week. I suggested this property is very unique that I'm selling next week. If you guys have seen it, it's my one where it's a giant shop on the ground and the house up in the air on the 2nd floor on 10 acres. It's very unique. But interest rates for the time we've had it on the market, interest rates are incredibly high, and buyers just, this kind of property is a want and not necessarily a need type purchase, and the buyers weren't buying it. And so I said, what if we offer owner financing? My client owned it outright. Let's offer owner financing. And a benefit could be you could offer it at a lower interest rate than market rate. Typically with owner financing, you're going to offer it 1 to 2 points above market rate. But for us, we were trying to get it sold and get more buyers to it. So when rates are 6 and 7%, we offered it at 5 1/4. And my client's thrilled with it and happy, and it's being sold and it's great. And we're going to go into all the details on that transaction in a second. So what owner financing does is help move property and make transactions happen when things aren't going to work out the traditional method. I know a couple investors who will buy homes, like they'll market that we'll do owner financing, and they'll say, hey buyer, if you have enough down payment, you can go find the home you want, I'll buy it. I will then mark it up a little bit, 5–10%, and sell it back to owner financing. So I'm making a profit on marking it up in the price, and then I'm gonna make money on the interest. So there's a couple investors in the area that have done that for years. That's always been a thing. It's a great way to do stuff. So benefits for buyers, you can close quickly. You can get a home when sometimes you can't, other routes. And there's a whole lot less fees, right? There's no appraisal, there's no survey requirement, although I recommend a survey still. There's no lender fees involved at all, credit reporting, none of that. So the benefit for a seller is, again, attracting more potential buyers, selling the property faster, and make money on the interest when you carry that mortgage. All right, any questions on that? All right, let's keep going. So first step, when a seller says, if you have a listing right now and they say, yes, I'd love to consider owner financing, you say, great. What kind of terms do we want to consider? Because when a buyer's agent's out there looking, they're going to ask, what are the terms you're looking for? And the terms don't have to be concrete right now, but you do want to have a general idea of the terms. So the first term you want to determine is how much down payment are they willing to accept? In my case, for the closing next week, we actually took less than I recommend, but that's a different story. What I'd recommend is a minimum of 10%, ideally 20% down. You want a good, healthy down payment because you want to make it painful so that they don't let it go back to foreclosure, right? The idea is we don't want to foreclose on the home. We can foreclose on the home and sell it to somebody else, but we don't want to go down that road. So if they put enough down, they're going to do everything they can to make sure they don't lose that money, right? So the idea is 10% is the minimum where a seller can pay and hopefully not have to write a check at closing, because that 10% down payment is what's going to be collected at closing, and the seller owes commissions, they owe title, they owe taxes, right? So out of that down payment, it's going to come all those fees, and then they'd like something left after that. So ideally, at least 10% down. Then there's going to be a balance for the mortgage payment. And that balance typically is going to be based on a 30-year amortization. So does everybody understand that? Like a normal mortgage, it's a 30-year payment, 360 months of payment. So the balance of that note is divided into, 360 payments of principal and the interest in there. So normally it's a 30-year am, but then it's a balloon, meaning you're paying a 30-year payment every month. But at some point, typically anywhere between 2 to 3, maybe 5 years, the balloon balance is going to be due. That forces that buyer to refinance it. So they fix whatever issue they have that they couldn't qualify for a normal loan to begin with, and they refinance it. They have a couple years to fix it, and then they refinance it into a traditional loan, or maybe they sell it by the end of the balloon, or maybe they've paid it off. So in my case, on my closing next week, it's a 10-year balloon. That is a little longer than normal. But again, my situation's a little weird. Don't do what I do. So I would say, 2 to 5 years is generally the norm on owner finance with a balloon. So, ideally, we want our sellers really not to go beyond 5 years. But if they want to go beyond 5 years and the buyer needs more than 5 years, as long as everybody understands the terms, it's fine. Typically, the owner is going to be able to bump up the rate 1 to 2 points above market rate. So if market rate today is 6 3/4, they should be able to offer 7 3/4 to 8 3/4. I know some people, some investors who own a finance, and they won't do it for anything less than 10%. So it's whatever the seller wants to do, that's the rate. But I would, again, you want to determine these factors, all these late people. Determine these terms and either attach it in MLS as like an attachment with, these are the terms we would like to see, suggested terms for owner financing, or just know agents are going to call you and say, hey, what are the terms, before they write up an offer. Any questions on these terms? Does everybody get this? Taking a drink before I keep talking.
Hey, Carlin, can you real quick go back to what happens after the 2 to 5 years really quick? What did you say?
So what I normally recommend we do is, you don't want your seller on the hook for 30 years, right? most sellers probably or may not be around in 30 years, right? We want an end game to this owner finance term. So what you normally do is say it's going to be a 30-year payment, meaning the payment's broken out over 30 years, the amount paid monthly, but we're going to balloon it, meaning at the end of 2 years, 4 years, 5 years, the balance is due. So that note, all of a sudden, for my situation, we did a 10-year balloon. So they're gonna make a payment every month, and at the 10th year, 120th payment, that balance of whatever's left on the loan is due. And if they don't pay it off when it's due, then my client can foreclose. That won't happen. That buyer will understand he has to refinance it. Usually they sell it before that happens. Or they could always renegotiate with the owner for an extension. But the balance is due, and technically that owner could foreclose at that point. Does that answer the question?
Yes, thank you.
Yep, for sure.
I have a question.
Yeah.
When you say refinance, they just go get a regular loan or something and they pay you off?
Yes, so ideally, if it's a normal property that could qualify for a normal loan, then the buyer gets 2 years, 3 years, 5 years to fix whatever the issue is, right? To show income on your tax return or to get your credit score up. My brother right now, he's a good example. He wants to buy a home, but he literally has no credit. Don't even get me started on that. But he literally stopped using credit 5 years ago and has a 0 no score. So I've looked at owner finance options for him to where we would owner finance for like a year, giving him time to do the credit, and then in a year he would convert it to a normal loan because by then he'd have the credit and can convert it. I don't want it to go beyond a year or maybe 2 because I don't want prices to go too high, and we want to capture rates. It's a whole timing thing. Anyways, besides the point. Okay, so yeah, the idea is you give them 2 to 3 to 5 years to fix whatever the issue is, and then they can refinance it. But in some cases, like my unusual house that I'm selling, it may never qualify for a normal loan. And so that's why we did a longer term balloon. We did a 10-year balloon, and the buyer's thinking he'll have it paid off by then. He's gonna make extra payments to it and have it paid off. But he could sell it, a lot of the lot or the house I mentioned that I own or financed, the property with all the homes on it. I took it over, I took the note over, and I maybe collected mortgage payments on it for about 1.5 years, and then they sold it and I got paid off. It was great. Okay, any other questions on this page? Moving on. So let's talk about my example, and then I'm going to show you all the paperwork on mine. So here's how we got to my situation. My seller really wanted top dollar on price. Their buyer was willing to pay 100,000 less than this price, but my seller, and he would have paid 100,000 less, and he would go get a loan. He would deal with financing himself, or he said, I'll pay your price of 875, but then you need to owner finance it to me. So that's how we got to this. So my owner's happy because she got the price she wanted, and she's getting a down payment. Now it's not the 10% that I recommend. She's going to bring a little bit of money to the table. We'll look at her numbers in a minute, but they're going to put 50,000 down. We're doing, like I said, a 10-year balloon. Now the 30-year payment on $825,000 was a little higher than the buyer was comfortable with. So we were willing to do a 40-year amortization, meaning we take that balance of 850 or 825 and break it out over a 40-year payment. And then again, we offered a lower interest rate because we were trying to incentivize buyers to buy this property, and rates are high and blah, blah, blah. So we did a 5.25% interest rate. So his monthly payment is $4,009 at 5.25%. Now, keep in mind, he's going to owe a ton of interest, right? Like, he's not paying that principal down very fast. And so the interest is going to accrue, and that balance that's due at the end of 10 years on a 40-year arm is much higher than had he kept it on a 30-year arm. Does that make sense to everybody? Should I say that again? Hope it makes sense. And guys, feel free to, Chat, raise hands, unmute yourself, ask questions. I wanna make sure I don't go too fast. Okay, so let's look at the paperwork for this. So the first thing is on the contract, on the first page, we're marking a seller financing addendum, and then we're attaching the seller financing addendum. So this is where he showed he's putting 50,000 down, we're doing a loan of 825 for a total purchase price of 875. Pretty easy, it's just not on the third party. Then, here's the seller financing addendum. This box here, A, credit documentation. This particular buyer is self-employed, and so we just wanted a snapshot of his finances, and he provided like bank statements and things. You could require credit report, you could require other stuff. But the thing to keep in mind is that if the seller is collecting a big enough down payment, even if the buyer ended up having to go to foreclosure, we have the quickest foreclosure process in all of the country. Texas is one of the fastest foreclosure states. So he could miss a payment, we could start foreclosure proceedings and have it foreclosed on within less than 2 months. So as long as your owner understands all this, is savvy, gets the numbers, gets the benefit, and understands how much they're making on their money, then they usually don't care about proving how creditworthy you are to buy this home, right? Usually there's probably some issue for the buyer. And so we're gonna overlook whatever the issue is. And just make sure they have enough of a down payment that I'm collecting at closing. And gonna let them make payments until they don't, and then I'm gonna foreclose on it. Does everybody get that? So then B is credit approval. And it just stipulates you've provided the whatever you required on A, and then you can buy it or not. The next paragraph is instructions for the attorney to draw up the note that's used at closing to make. And we'll talk about all that in a second. So our note in our case is for 825,000, the principal balance. And it's gonna be, we ended up doing 5 1/4. They tried for 4 something and we said no way, so we did 5 1/4. We then said it's gonna be monthly payments on the 40-year arm, that's what that is. And it includes the interest. It begins April 1st and it's gonna go for 10 years, which is 120 months. Everybody with me so far? Okay, so if you were gonna do like a 5-year arm, then this would be 60 months here. Or a 2-year arm would be 24 months here, right? This normally would be a 30-year payment, not a 40-year, but again, this buyer wanted a lower payment. We make more money, so sure, happy to do that. Okay, the next document that's gonna be drawn up, promissory note's the first one, stipulating how we're making the payments. Then the next instrument's called a deed of trust, which secures this note to the property. This is the vehicle by which we can foreclose if they don't pay. So we are gonna mark either consents required or not required to sell the property. I typically never have needed consent to sell it. I don't recommend it. Like if they wanna go sell it, I'm gonna get paid off, right? My lien is filed through the deed of trust at the county, so they cannot convey it to somebody else without my permission, without me getting paid off. I don't wanna have to give permission, like, please sell it, but I wanna make it as easy as possible. Everybody with me? All right. The deed of trust will provide that the buyer must have casualty insurance and that the owner is a mortgagee on that insurance. We definitely always want that, because if the house burns down, we want to make sure we're insured, just like your bank would. Then we're going to decide if escrow is required or not required. In our case, we decided not to, but they still have to provide evidence everything's paid. Or we could say, no, we require escrow, and we can require that we use a third-party company to do it. And there are third-party companies that will collect the payment every month, the escrowed payments, so PI and TI. And then they pay out all the different things. They collect money until insurance is due and pay the insurance. They collect money on taxes and do it that way. We do not require it, but you absolutely can. If it's a first-time home buyer at a lower price point, I would 1000% require an escrow. This is a more savvy buyer. He's on multiple homes. He's got money. we didn't require it. However, my seller will, again, every year get proof that the taxes are paid. Any questions on that?
Yeah, so it sounds like your seller really trusts this buyer.
Yes and
Or they
no.
feel comfortable, they feel comfortable not requiring.
So,
Not requiring consent and not doing the escrow.
yeah, I mean, they get to foreclose if the guy doesn't pay. Whether he doesn't pay us or he doesn't pay the taxes, we get to foreclose. So it's more about her goal, which was getting the higher price for the home and getting it off of her shoulder. She didn't want the responsibility of this property anymore. And so this was the first buyer that really wanted it, who needed this situation. And so it's a risk reward situation. But worst case is that they stop paying, either they don't pay their taxes or they don't pay a mortgage payment. She then can pay an attorney a couple grand to foreclose, take it back 2 months later, and now she can go sell it to somebody else at a higher price probably, right? We're thinking the home's only gonna be worth more. She can turn around and go sell it to somebody else. And she's kept that down payment and she's made all the interest on the money up until that point. Remember,
In this
mortgages
case,
are very interest heavy up front, so you're making a ton of profit in the beginning. What were you gonna say, Gabe?
oh, just in this case, the consent wasn't required because they were like, hey, we're not worried about it, considering all the money. For whatever this reason, she's okay not requiring it.
The consent or the escrow?
The consent.
The consent to sell, I don't recommend you require a consent to sell. Like you want to make it as easy on them to go sell it to somebody else. And if they have to.
Or you don't want to be an extra roadblock in the way of them selling the
Exactly.
property.
Right. So to me, it's like, man, yeah, if you want to sell it, you knock yourselves out. I'm getting paid off. That's all that matters. And that deed of trust is going to ensure you get paid off. So I don't believe in consent, but escrow, I usually do believe in. In this particular
I
case.
mean, you should always get consent. Sorry.
Thank you for that. Yes. Any other questions on this one?
Carlin, I've got a quick question. So on the escrow required, so there's escrow companies that you can do. Do they also collect the mortgage payment?
They
And
do.
then
So,
everything gets-
yeah. So instead of the $4,009, we would say escrow is required, and then we would go hire the third party. You would usually make the buyer pay for that third party
Okay.
because the buyer's getting the benefit of all of this. And then that company will like you have to turn in the property tax statement, the insurance statement. And then they say, okay, buyer, your total monthly payment to us is $5,200. They collect the 52, they pay the 4,009 to the owner, the seller, they pay, and then they collect and accrue the insurance and taxes to pay those bills when they come due.
What kind of like normally charge? Is it like 1%?
It's like $30 a month.
Okay.
Well, I say that I haven't priced it recently, but when I did it, my last note, I required it. It was like $32 a month.
Okay, all right. So not a big expense, but a big
No.
headache off the
Yep.
seller.
For
Okay.
sure. Yep. Good question. Any other questions? Okay, so let's look at my HUD because I feel like this will help you all grasp what we're doing here. So on the right-hand side is my seller, and it's on a HUD and not a CD because it's kind of handled like a cash transaction, even though it's not cash. Okay, just bear with me. So we've got a purchase price of $875. We then are gonna have a loan of $825. So out of the money that she's collecting, she's turning around and keeping it essentially, right? Using it as the mortgage. So from her proceeds that she's gonna receive are being reduced by that amount. It's also being reduced by her normal closing costs, just like a normal closing. And then she's crediting the buyer for property taxes, just like a normal closing. So when you add those all up, because she's only collecting $50,000 up front, she's only gonna get she's paying $2,500 at closing to do this deal. Now, remember, I suggested you do at least 10% down. Had we done 10% down, she would have collected about $35,000. Does that make sense to everybody? We're gonna look at the buyer side in a second. Okay, So on the buyer side, it acts just like a normal loan. So he's got closing costs, he's got HOA credit because the seller paid HOA through the end of the year. Total it up, less his earnest money, less the loan that the seller's carrying over here. And his option money. Property tax credit from the client through closing is, so his deposit of earnest and option reduces what he's bringing to the table. Plus the taxes reduce what he's bringing to the table, so instead of the 50,000, he's bringing almost 42,000. Does that make sense to everybody? I hope so. I get nervous when you guys are quiet.
Well, I'm curious, you said a lawyer would do it. Is his fee part of that closing cost or is it separate?
Yes, yes, so I don't have page 2, but over here, under the 51.5, she paid about $550 to an attorney to draw up the note in the deed. And we used an attorney at this title company, but the client can hire their own attorney, whatever you wanna do.
I was about to ask that. So is it easiest, like, I mean, obviously a lot of us are in Hayes County. Is it easier just to do Independence Title and then use,
Lucinda,
Lucinda? Okay,
Yep,
got it.
yep, that's who's drawing up ours. Yep, for sure. All right. So now let's talk about the 2 documents at closing that are gonna be, that make this happen. So the deed of trust is the instrument that creates the lien that allows the owner to foreclose if needed. And again, a title attorney or a seller can get their own attorney to draw this up. You always want, like, you could make the buyer reimburse for that fee, but you want the seller to hire the attorney and get their own documents drawn up. You never want a buyer to have control of that, because you want to make sure all the legalese is in that document to enable the foreclosure. The note is what outlines the payments, the term, the rate, you know, when the balloon is, all of that stuff, plus the late fee. So after, you know, the 5th of the month or the 15th of the month, a 5% late fee, blah, 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 blah. So those are the 2 instruments that are going to facilitate and make this happen. And it's that seller financing addendum back up here, this note piece, that instructs the attorney on how to draw it up. That makes sense.
What's the timeline for that? Like,
It can
when does
happen pretty
that-
quick. You-
okay,
Yeah, title can do this, like you could close these in 2 weeks or less. Mine took like 8 weeks or 6 weeks, but only because we had to get my seller out of the property and that has taken over. But it can be really quick. Okay. What happens if there's a mortgage in place? So now we're gonna talk about wraps and subject twos. But any other questions on just normal owner financing where the owner carries the lien? Okay. Let's jump into, so let's say our seller, and we're seeing these offers all over the place. The owner has, you know, on a $400,000 home, they owe $250,000. There's a mortgage in place. We're gonna talk about the 2 different options that would convey the property. I am not saying I like these options. Let me clarify. I love owner financing. I do not love wraps and subject twos. It doesn't mean we can't do them, but we're gonna do them in a very, very specific way, and we'll talk about that in a minute. Okay, a subject to means it is subject to an existing mortgage where the buyer's gonna take over payments of that existing mortgage. They're assuming the loan without assuming the loan. That buyer is taking advantage of the seller's loan and they're not having to qualify for the loan. They're not, it's not gonna be in their name. The loan stays in the seller's name, and I don't like that. But it can work for certain situations. The seller has to understand that they're staying on this loan. The buyer gains ownership of the property, so there's still a closing. But the mortgage is gonna stay in the seller's name, and then the buyer is gonna make payments to the lender or through a servicing company again. You don't want the buyer making payments to the seller and the seller making payment to the lender. Because what has happened in the past is that the seller will collect all those payments and not make the payment to the lender, and then the home gets foreclosed on. So that won't happen. The benefits, it allows a buyer to get financing and buy properties with very, very little down and not using their credit. So, you know, you hear and see these webinars and classes all over the country, you know, learn how to get rich with none of your money in real estate, right? Like that's what this is. And in some circumstances, you know, 1 out of every 20, 30, I don't know the percentage, but very little percentage. There is a percentage where these sellers, you know, have to get to another state. The home's not moving. I do want to consider this because I just need this payment to not hurt my credit. You know, like maybe they can afford to still buy another home with this one in place. You know, there's a lot to it. The biggest risk and consideration that I want to make sure we understand is that the existing lien that this buyer is taking over paying says if the property sells to another party, the mortgage is due. It's a due on sale clause. And we're basically ignoring that clause and conveying the property. And what that means is if the bank ever were to catch wind of this and figure this happened, they could legally, technically call the note due right then and there. They could say you violated the terms of our mortgage, we're foreclosing right away. The school of thought, and if you talk to the attorneys that specialize in these, is that it very rarely happens because if a payment's being made to them and they're making money on the interest, and why go foreclose on the home, right? Foreclosures are risky to banks, they cost the money. They usually lose a lot of money when they foreclose on a home, they don't want to foreclose on the home. So it doesn't happen very often, but we certainly can't say it's never gonna happen. I definitely don't like subject tos and wraps on VAs. And I definitely don't want a subject to or a wrap when a mortgage payment, when the current owner has been late on their mortgage lately. Like if we're paying it on time all the time and it's consistent, it's probably fine, but the minute the owner misses a payment or two, then that bank starts paying attention to that property. And so it's much more likely to get called due if we do it that way, so we don't want to do that. That is what's called a subject to. Does that make sense? And it'll probably make a little more sense when I talk about our app in a second as well, but any questions on that?
Yes, is there a way in which we can ask the seller how we could clarify whether or not they've been late or there has been any issues?
Yeah, I mean, you can make them prove, so they can log into their mortgage, you know, platform and show you when they've made their payments over the last 12 months, for sure. Either they can provide a statement of account that shows when they've made their payments, or they can provide, you know, the mortgage payment coming out of their bank account for the last 12 months, 1000%. Okay, we're gonna come back to the risks again in a second, so don't get too hung up on those, guys. Okay, let's talk about a wraparound. A wraparound is the same situation. There's an existing lien in place. The difference is that besides a down payment, the buyer's also going to pay a little bit more monthly to the owner. So let's say, and I should have done numbers for you on this, but let's say we're selling the home for 400,000, the mortgage is 225, and the buyer's only putting, you know, 40,000 down. So there's a huge payment, you know, the difference between the down payment and the mortgage of principal money that's due to the seller from the buyer. That would be a second mortgage that wraps around the first. So now he's making the payment on the first, plus additional funds that go to the owner every month to pay off that other balance. That's why it's called a wrap, is that a second mortgage is wrapping around that existing first mortgage. So it's just like a subject to, only there's more money due. And so the seller's gonna make a monthly payment every month. And I think I did do an example. Yeah, okay. So existing lien has a monthly payment of $2,100. In a subject to, they're just paying the $2,100 plus that down payment. But in a wrap, they're gonna pay the $2,100 plus the down payment. And And in this circumstance, the total payment with the wrap is $2,300 a month, so the seller's getting the $200 difference every month. Does that make sense? Any questions? Okay. One more note, and then I'm gonna let you guys go unless you have questions. So buyers and sellers have to understand the risk. We have to be incredibly transparent and into what's going on. It's only going to work in very specific circumstances. So I, as a broker, want you guys to close these if you're going to do one. Close them with Shesker or Wally Tingley at Tingley and Associates. Alan Shesker and Wally both do these all the time. They require both parties to come and close together so that we are fully transparent, everybody's on the same page, which I love about that. They have additional resources about all of these on their websites. And then Shesker Group even has a class that you can pay a couple $100 to take online that goes into more details than this. There are more things to kind of understand about these, but I feel like it's really overwhelming to grasp it to begin with, so I didn't want to get too detailed. What questions do you guys have for me?
So one of my sellers questions is what happens on the subject to if that buyer stops making payments? What are their, how do they get the property back?
So the minute they stop making the payment, they are gonna wanna foreclose. And they should make the payment on behalf of that buyer who stopped to ensure the primary lien holder doesn't foreclose. Does that make sense? So they've
Okay.
gotta protect their position and ensure that they aren't out the money.
So as soon as that payment is late and they've received notice that it's late, they should go ahead and pay it. And there's usually a provision in that subject to that says if it's late that the owner gets the property back.
Well, yeah, essentially, yes.
Okay. And then they would just, if they had a hard time with that, they would need to just go to court or just be a normal foreclosure process. They would just foreclose on that buyer.
Right, exactly. So the paperwork says that they're entitled to late fees, they're entitled to attorney fees, like they get to be reimbursed all of that. The problem is if that buyer has overextended themselves and there's no money to collect, then it won't matter, but yes. Yeah,
Okay.
yeah, the key is though, you just want to ensure you're protecting your position on that note, on that mortgage, so that the first lien holder doesn't foreclose. But, 1 month of missed payments, the bank's not foreclosing. 90 days, 120 days, they're now thinking about it, so. And some banks foreclose much quicker than other banks. Like I've seen banks take years to foreclose. Like it's crazy what I've seen, but you just never know.
One other question, what happens if that buyer on the subject too decides to sell the property?
So you would have a clause in there that ensures that everybody's getting paid off before it can change hands.
Okay, so they wouldn't be able to do like another subject too.
You would want to make sure the paperwork does not allow.
That's gotta be, okay.
1000%.
And that paperwork would be the Wally and Tigley, like that's what they
That's
take
why
all
that's
the
why I
time?
want you guys to use Chester or Wally. So what happens on subject twos and wraps typically is that these buyers have done this many times before, usually, not always, but usually. And so they will come to you in your listing and present their own contract or their own addendum to the contract. And at that point, we're not attorneys. We can't interpret what those say. And so you kind of want to be like, okay, if we're going to consider this and go down this road, we need an attorney on our side. I highly recommend that one of the things we do is ensure that we close only with these two title companies. And then we do know that they're going to make sure they're educating everybody and keeping everybody on the same page. But again, the title companies, even though you're going to Shesker or Wally, who's done them correctly, they don't necessarily represent your seller. They can't do that. They're still a neutral third party. But they can absolutely answer factual questions about the paperwork. But depending on how complex it is, you know, I would still advise your clients to talk to an attorney. They don't necessarily have to, but we want to advise them to.
Carlin, can I ask a quick question? Since this does get so legal and obviously that's gonna be a suggestion, like if, can we come back and be like, well, we need like a $1,000 option or $1,500 option, so we've got the money to go to the attorney? Is that
Sure,
kind?
absolutely, yeah.
All right.
Now, whether the buyer's gonna wanna do it or not, I don't
Yeah.
know, you know, like some of these buyers are sketches all sketch, not all, but some of them are just out there trying to find desperate sellers and get a great deal, and they put very little money down. You know, they have very little skin in the game, and they think they're just gonna go rent the home out and cover that mortgage payment and have no intention of paying for it otherwise, like, sometimes they scare me a lot, but you know, in some circumstances, it does make sense.
And I've got one more question. I'm so sorry.
You're
Is
good.
this, so is the, like on the tax records, like I guess I'm a little confused on this wraparound, the subject to and wrap. So are they listed as the owner? The buyers are listed as the owners. So it closes
It's
the
changing
title.
hands just like an owner finance.
Okay.
Only difference is the note that outlines the mortgage that's in place is still in your seller's name.
Okay. And I guess, and the mortgage company doesn't get, like, that doesn't flag it like automatically?
So there's no reporting mechanism to the mortgage bank that
Okay.
says, hey, this property's been sold. That's how all these thefts are happening, right? Buyers
Okay.
are buying property from fraudulent sellers because there's no, it's not like credit reporting where there's a centralized hub that tracks it all and tells everybody, right? It doesn't exist. And so the banks don't know if a property is conveyed other than perhaps now they're getting payments from somebody else or the mail's going somewhere else. But again, if the bank is collecting payments and getting paid monthly, then they don't ask questions and look to stir the pot. They just want their money, right? So,
Okay.
yeah.
So would a seller keep, like, so let's say if you've got like insurance and, you know, you got escrow wrapped up into that mortgage payment, what, do they have to like take that off or they just keep it? And then we do that escrow company thing?
So, well, no, so if escrow is required on the first original loan, then
Right.
escrow is still gonna be required because that bank is requiring that escrow. The
Okay,
difference is you're gonna say, oh, don't pay that insurance bill, now pay this insurance bill because the insurance is now in somebody else's name.
oh, okay,
Yep,
okay.
yep. All right, guys, any other questions? I know that was a lot of information. Uh-oh, Talitha's coming in. She just missed the whole thing. This will be, this recording will be on the YouTube channel and I'll put these slides on our portal for you guys, so they'll have them. And just, you know, the minute you get an offer and your seller's considering it, you can get me involved. I'm happy to talk to the seller and explain things, you know, whatever we need to do. But we just need to be really, really clear with the risks and the pros and cons to your seller or your buyer. And let them decide for themselves. Okay, guys.
Carlin, I've been on the
Uh-huh.
whole time.
Oh, you have?
Yeah, I just tried to log in on my phone too, so that I could
Oh,
listen while I drive.
that's hilarious. Okay, it's like, oh dang, she missed it. Good. Okay, so yeah, I'll go put these slides on the portal, but that's all I've got for you guys. Thank you for being here.
Great
Thank
info.
you.
Thanks so much.
Thank you.
Bye.